Buying your first index fund might feel overwhelming, but I promise it's simpler than you think. Think of it like setting sail on a new journey. You just need a good map and a sturdy ship. In this tutorial, I'm going to walk you through every single step, from opening your brokerage account, all the way through to placing your first real trade and managing what happens next. By the end, you'll have concrete knowledge about how to put your money into an index fund with confidence. First, let's talk about what an index fund actually is. An index fund is a collection of stocks that tracks a specific market index. The most popular is the S&P 500, which contains 500 of the largest companies in America. When you buy an index fund, you're buying a tiny slice of all 500 companies at once. This gives you instant diversification. Instead of betting everything on one ship, you're spreading your risk across an entire fleet. Now, before you can buy anything, you need a brokerage account. This is your gateway to the markets. A brokerage is a company that holds your money and executes your trades. Think of it as the harbor where your financial ship docks. Some of the most beginner-friendly brokerages include Fidelity, Vanguard, and Charles Schwab. These companies are well-established, insured, and charge low fees or no fees at all. Let's walk through opening an account at one of these brokerages. Start by visiting their website. You'll look for a button that says Open an Account or Get Started. Click it. You'll be taken to a form where you enter your personal information. They'll ask for your full legal name, your date of birth, your email address, and your social security number. This is normal and required by law. Next, they'll ask you to verify your identity. You might need to take a photo of your driver's license or passport. Some brokerages use instant verification, which takes just a few minutes. Others might take a day or two. Don't worry, this is standard procedure at every legitimate financial institution. Then comes the funding step. You need to tell your brokerage how you want to deposit money. Most brokerages let you link your bank account directly. You'll provide your bank's routing number and your account number. This might sound scary, but these companies are heavily regulated. Your bank account is not charged or accessed unless you explicitly authorize a transfer. Once you've funded your account, you'll see your cash balance appear in your brokerage dashboard. Now the real fun begins. You're ready to search for and select your index fund. This is where many beginners get confused, so pay close attention. When you search for an index fund, you need to know that the same index can be offered by different companies. For example, Vanguard offers an S&P 500 fund called VFIV. Fidelity offers one called FXAIX. Schwab offers one called SWPPX. These three funds all track the same index, but they're technically different products offered by different companies. If you're opening your account at Vanguard, you'll buy the Vanguard version. If you're at Fidelity, you'll buy the Fidelity version. Here's how to search for an index fund within your brokerage. Log into your account and look for a search bar or a link that says Buy or Trade. Click on it. You'll see a search box where you can type the fund's ticker symbol. A ticker symbol is a short code, usually 3 to 5 letters, that identifies a security. For example, VFIV is Vanguard's S&P 500 fund ticker. Let's say you've decided to buy VFIV. Type VFIV into the search box and hit enter. The fund will appear in your search results. Click on it to see more details. You'll see information like the fund's expense ratio, its holdings, and its performance history. The expense ratio is how much the fund charges you annually as a percentage of your investment. For most index funds, this is very low, often under 0.1% per year. Read through the fund details to make sure you're comfortable with it. Then, click the Buy button. You'll be taken to an order form. This is where you'll actually enter how much money you want to invest. You have two options. You can enter a dollar amount, or you can enter a number of shares. Let's say you want to invest $1,000. Enter 1,000 in the dollar amount field. The brokerage will calculate how many shares that buys you based on the fund's current price. For example, if the fund costs $100 per share, your $1,000 would buy you 10 shares. The exact number might be 10.03 shares or 9.97 shares, depending on the exact price at that moment. Now you'll see a review screen. This shows your order before you actually place it. Check the details carefully. Make sure the fund ticker is correct, the dollar amount is correct, and the account type is correct. Most brokerages offer regular taxable accounts and also retirement accounts like IRAs. For now, a regular taxable account is fine. You'll also see an option for order type. The default is usually market order, which means you're agreeing to buy the fund at whatever price it's trading at when your order executes. This is normal for index funds and is what you want. Some brokerages also offer limit orders, but you don't need to worry about those for now. Once everything looks correct, click the confirm button or the place order button. Your brokerage will execute your trade. Depending on when you place it, this might happen immediately or at the end of the trading day. Index funds are typically priced once per day after the market closes at 4 p.m. Eastern Time. Congratulations, you've just bought your first index fund. You're now a part owner of hundreds of companies. Your money is at work in the global economy. This is genuinely exciting, but now comes the critical part: what to do in the days and weeks after your purchase. The most important thing you can do right now is nothing. This is not a joke. Your biggest enemy after buying an index fund is the temptation to fidget with it. Don't check your account balance every hour. Don't panic if the value drops by $50. Market fluctuations are completely normal. The stock market goes up and down constantly, but over long periods it trends upward. If you're investing money you don't need for at least 5 years, short-term drops don't matter. One thing you absolutely must avoid is selling during a downturn. If the market drops 10% next week, many new investors get scared and sell their funds. This locks in your losses and breaks your investment plan. Remember, you bought this fund because you believe in long-term growth. Don't abandon that strategy because of temporary volatility. Another thing to avoid is trying to time the market. Some beginners buy an index fund and then obsess over whether they bought at the best price. This is a losing game. Even professional investors can't consistently time the market. Instead, focus on consistent investing. One of the best strategies is called dollar cost averaging, which means investing the same amount of money at regular intervals, like every month or every quarter. You should also avoid the temptation to switch to a different fund after a few months. Maybe you'll read an article about a tech index fund and wonder if you should sell your S&P 500 fund and buy that instead. Don't do it. Switching between funds locks in gains or losses and often incurs tax consequences. Stick with your original plan. Here's what you should actually do in the weeks after your purchase. First, set up automatic contributions if your brokerage allows it. This is incredibly powerful. You can schedule your brokerage to withdraw money from your bank account every month and automatically invest it in your index fund. This removes emotion from the process. You don't have to remember to invest or decide when to invest. It just happens automatically. Second, consider the tax implications of your account. If you're investing in a regular taxable account, you'll owe capital gains taxes when you eventually sell. But you don't owe taxes just from owning the fund. You only pay taxes when you actually sell and realize a gain. This is another reason not to sell. You're not just abandoning your investment strategy, you're potentially triggering unnecessary taxes. If you have access to a retirement account like a 401k through your employer, or a traditional or Roth IRA, you might want to prioritize investing there instead of a taxable account. These accounts offer tax advantages that can significantly boost your long-term wealth. But that's a topic for another video. Third, understand that you now own a diversified portfolio. Don't feel like you need to own other stocks or funds. Many beginning investors feel like they should own Apple stock or Tesla stock or some other individual company. The truth is, by owning an S&P 500 index fund, you already own Apple and Tesla and thousands of other companies. You don't need to buy individual stocks on top of that. Fourth, resist the urge to sell based on news headlines. You'll read articles about a market crash or a recession or a bad earnings report. You'll feel panic and want to get out. This is when discipline matters most. Markets have recovered from every single crash and crisis in history. If you sell during a downturn, you miss the recovery. Fifth, celebrate your decision. You've done something most people never do. You've opened an investment account and put money into the markets. You've taken control of your financial future. The fact that you're learning about index funds and thinking about long-term wealth puts you ahead of millions of people who do nothing with their money. Now let's talk about some additional things to keep in mind as you continue your investment journey. As your account grows, you might receive dividends from your index fund. These are small cash payments that the fund distributes to shareholders, usually quarterly. You can either take these dividends as cash or reinvest them automatically. For most investors, automatic reinvestment is the better choice. This compounds your gains over time. You should also understand that index funds are passive investments. You're not hiring a fund manager to pick stocks and make trading decisions. You're simply buying a basket of stocks that mirrors an index. This is why index funds have such low fees compared to actively managed funds, where a manager charges higher fees to pick stocks. Don't compare your index fund's performance to individual stocks. You might see that one company's stock went up 50% in a year, while your index fund went up 7%. This creates regret, but it's misguided thinking. That one stock might crash next year, while your diversified fund is steadier. The whole point of index investing is stability and consistency, not chasing home runs. As you become more comfortable with investing, you might want to learn about other types of index funds. Total market funds own thousands of stocks instead of just 500. International index funds give you exposure to companies outside the United States. Bond index funds own government and corporate bonds. These are all valuable, but for most people just starting out, a broad market index fund like the S&P 500 is perfect. You should also be aware of how much you're contributing over time. Investing $500 once is fine, but investing $500 every month is powerful. Over 30 years, consistent monthly investing can turn you into a millionaire, even with average market returns. This is the magic of compound growth. Your money doesn't just grow from your initial investment, it grows from all the subsequent investments and from the returns those investments generate. Finally, remember that investing is not a sprint, it's a marathon. The best investors are patient investors. They buy quality index funds and hold them for decades. They don't check their accounts daily. They don't panic during downturns. They just keep investing and trust the process. You've now learned how to open a brokerage account, search for and select an index fund, place your first trade, and manage your investment afterward. You know what to do and what to avoid. Most importantly, you understand that buying index funds is not complicated or risky if you do it correctly and maintain discipline. You're on your way to building real wealth. Congratulations on taking this important step.